Hello there, everybody. Michael Silva. You are watching the Stock Market Brief Show. I wonder how many people just got off. They're like, what am I watching? Just go ahead and go to the next video. You're watching the Stock Market Brief Show. My name is Michael Silva. If you're new here, make sure to hit that thumbs up, subscribe to the channel. If you like technical analysis and intermarket analysis, today's video, it's all about looking behind the curtain, seeing what's going on behind the scenes and how that matches up to past history. Why? Well, because it's all going to look so obvious if something were to happen. But instead of being blindsided by an event that takes place or some big move in the markets, we like to prepare ourselves so we're not blindsided. Because in this video, this channel, we're all about preserving capital, growing capital, and just managing risk overall. Now, we did get some manufacturing data out today, the PMI. It improved. Woohoo! Bullish, right? 47.1. Expected was 46.6, but the reality is we're still in contraction, and this is the 6th month, right? Let's count 1, 2, 3, 4, 5, 6 months under 50, which is in contraction still. So yeah, we're getting a little bit of a move up, but still understand we are below that 50 marker. Now we have a lot of macroeconomic data coming out. We have jolts tomorrow. Then we have the big stuff going on, the Fed interest rate hike decision, which you can pretty much put it in the bag that we're getting a 25 basis point rate hike. If he comes out and does not raise it, I think the market's going to like that. I also think that the market might like a 25 basis point hike. Depends on what he says after that fact, saying that maybe, hey, we're going to go ahead and pause now and let it go, right? If that's the case, and he doesn't, hint towards another 25 basis point hike, I think the market might perceive that as good news and potentially rally until they settle in. They're like, well, actually, we're going to hold rates here longer than expected, right? That's what they said last time, their base case. And then they might potentially sell off due to all of the seasonality, higher rates, earnings seasons, right? We got some big stuff coming up here Tuesday after the close, before the open right over here. So we have Uber, Pfizer, a couple of them to keep a close eye on there. What happened with all that data that came out today? Absolutely nothing in the markets. The markets didn't budge, right? Pretty much flat on the day overall, a little bit leaning more towards the defensive side. And you could see here we did get above that 4,200, and I was looking for a potential breakaway over here, but we got sucked right back down into this 100-point range that we've been in for a month. Now, if we take a look at the 5-minute chart, right, you can see even though the markets didn't do much, they did do a lot. Now, today was known as May Day, and that's when the European markets are closed. So that's also why you might see less volume and more chop. So as the markets reopen up, and the European markets reopen up, we may see volume come back in, and then we might get some more decisive potential trend days. But you can see we started off a little bit slow, and we saw a big rocket move up to the 4,200 level, or right around there, and then we started pulling back down. We came back above. I was looking to play this bull flag into the day, but we cracked down through that and started breaking down, unfortunately, and we closed right at about the low of the day. Now, it was a flat day, so let's take a look really quick of what held the market up and what was pulling it back down. And I'm just taking a look at the gainers of the S&P 100 and the ones that have been lagging the S&P 100. These are the bigger names within, obviously, the S&P 500. But you have like NVIDIA, right? NVIDIA was the big dog holding the market up. It was up 4% on the day, where you look over here and you have some of the banks that were down. We'll touch more on that later on the regional side. But then you had like Amazon, XOM, to say a few. We even had Netflix was one of the worst performers early on in the trading day there too as well. Now back to NVIDIA, this was a huge move in a single day. It actually came up to its upper weekly expected move, which we shared on the last brief. And you could see it just danced around there the entire day, right? We came up to that level. Boom. What did we do? This is why it's important to track this. We just doodled around. And now even in the aftermarket session, we're right there. So upside potentially limited for the remainder of the week. It's always possible that we break out further, but you just got to be cautious going long in an area like this. To me, you play the breakout and you take some profit at these levels versus try to go long at an upper expected move. A lot of people, when we hit these upper weekly expected moves, people look to sell premium. There's a bunch of different, opportunities or ways that you can trade this, but I just wanted to call out that we're already there day one of the trading week at that upper weekly expected move. If we take a look at the Bookmap software, if you're unfamiliar with this is software that I personally use trading intraday because it allows me to see key levels that you cannot see on a candlestick chart, right? A candlestick chart does not show you the order book, where are orders hiding out. This does, and it does it in a way that's not like level 2s where they flicker across your screen. They put up, it's a heat map, right? So I'm showing you this. This is ES. This is the day trading ES, right? And then we closed right over here. And I like to bring this up towards the end of the day and layer on the expected moves for the daily time frame. So upper daily is 4201. I have that labeled right here. The lower daily is right here. And you can see that it's actually by some higher areas of liquidity. You can see this kind of white line beneath that white line, right at 4,200, 153 contracts. And then down here at about 160, slightly lower, you start to see these lines going across the screen, okay? Now, there's a couple other levels that I want to just call out here. It's at 4172 level, has a bid that's solid there. And then that 4160 that we just previously mentioned, it's actually been there for quite some time. So the longer it stays here, the more likely that we can see price try to find, buyers, and it could potentially push down in this area. On the flip side of that, you can look up here where there's 259 contracts hanging out for quite some time at 42.35. So the longer this stays up there, I want to pay more attention to it because it could be telling us that, hey, we might try to find some supply up into that area. So that's a level to obviously pay close attention to. Now, what else happened in the news today? Well, this you probably saw come across your Twitter feed or whatever news feed. The U.S. could run out of cash by June 1st. That's Janet Yellen warning. Yay! But don't worry, right? Pepe is going to be banging on his drum, hopefully building up that great coin that they have here that's up apparently 27,000% in the last 5 days. But I digress. This is interesting to me because we're coming into the debt ceiling. That's what this is all kind of sparking right here. And when I look at something like 5-year CDS, so credit default swaps, look at this big spike in recent days up to 52.76, and you look back to the left of the screen, we haven't been there since the great financial crisis. And you could see back in 2010, 2011, we started seeing a rapid rise, very similar to how we're seeing here. Now, we're not actually at 52.76. I don't know why this didn't load properly, so I pulled up the data. We're at 41.96, which would put us up right about here, but we did hit a higher point, so it just backed off a little bit. But this is crazy because these have rose 30% in the last week, 53% during the last month, 174% this year. And this, to me, is a big warning sign. Why? Well, because we have the debt ceiling stuff coming up. And if you remember 2011, we had that debt ceiling crisis. And both CDS was on the rise like this. We had the debt ceiling coming up. And in 4 months, we fell 20% in the S&P 500. So that was a very rapid hit to the downside. And look at the seasonality perspective of this, people. We're in May, right? This is May 2011. We're in May currently right now, going into this summer month. So we have bad seasonality. We have poor breadth that we've been pointing out. Credit default swaps are on the rise. A lot of uncertainties in the market that it's going to look so obvious later down the road if something bad were to happen. And that's why it's so important to protect and preserve your capital in these times. You got to be very diligent. Okay. Now, I know that there's a lot of bullish sentiment out there. There's bearish sentiment. People, we don't know what to do exactly. There's some people saying S&P 500 is going to hit 6,000. There's other people saying it's going to hit 2,000. There's all kinds of crazy stuff out there. And then we're talking about like that's going to happen this year, right? Let's just step back. Let's take a look at something like the regional banks, right? So if you are really bullish, understand that regional banks are still, like just a week ago, like a few weeks ago, it was like they forgot that there was a financial or a banking crisis, but now it's starting to hit the news again. And just take a look today, something like, I forget the VLY, I think that's Valley something, I forget the name of this one, but it was down 20% today. We had a couple other big ones down like CFG, Citizens Financial, right? It's down 6%, but everything was down in the red. If you just take a look at KRE's, 2 days separated from its low point since this all started. So we haven't seen really anything go on here and nothing from a positive sign. And, Jim Bianco pointed out that Buffett, he's the greatest of all times, largely because he has invested in banks for over 50 years and no one understands it better. But what he pointed out, what I thought was interesting is, what? There we go. He says, so I've noted his absence in all the happenings in the regional banks in the last 2 months. He is not investing. And to me, this speaks volumes. Okay, so it is interesting to note that he typically is somebody who would take advantage of this situation, and the fact that he hasn't does, like he said, speak volumes. Okay, so like I said, this is all about, it's going to look obvious later if something bad happens. That doesn't mean something bad is going to happen, but it will look very obvious if it does, right? Okay, now let's take a look at the dollar. The dollar started to perk up a little bit. Overall, just an inside trading day, but it's, flirting with that 102 level. If we start breaking back up here in the dollar, that could be bad for like gold. It could take a little bit of a back seat temporarily as it's been on a pretty rampant run. And then it also could be bad for assets like the S&P 500, where we saw our channel right here, right? While that was breaking down, the S&P 500 was moving up. Now, if this starts breaking up, is this going to tell us that the S&P 500 may come down? That's a possibility. We also have the 10-year yield firing off like a rocket ship today, up 3.53%. So the 10-year yield is now at 3.574% as it closed at 35.74. What happened to bonds? Well, bonds got crushed, down 2.88%. I actually took advantage of this, and I bought some pretty much right at around the low of today. I didn't share a screenshot on Twitter, so you just got to take my word for it, but I did. I added to my position. I've been trading within this chop over here. Now, it is below all these key moving averages, so this could be an area where we go down further. I still believe that we're in stage one. Recently, the start of stage one in the business cycle, and that is where stocks go down, commodities go down, but bonds, they typically go up. I will negate that if we start taking out the low down here in October, but as it stands right now, we're up and we're treading sideways. We are in a stage 4 decline that was very apparent right here, but now the moving averages are starting to flatten back out. So as long as we recoup this level and get above 110, I'd be more bullish there for bonds. Even if you take a look at the curves, the 10-year and 2-year is still deeply inverted, right? 55 basis points. 10-year and 3-month is even, flatter than a pancake over here. 168 basis points inverted, which is not good. Okay, it's not healthy. If we take a look now, we'll just go into the SPY and the Qs on the 15-minute time frame. The daily expected moves are highlighted in white. We did not hit our daily expected move for today. We came close, but we didn't tag it. Remember, think of them as a bell curve, right? Bell curve, boom. 68% of the time, it works every time. I'm just kidding. 68% of the time, it'll close within this range. So, it's important to note these because they're good risk management tools. If price starts getting outside of it, or even to it, you may want to look to take some profits if it starts getting above it, right? Very same situation. The upper and the lower orange levels, those are the weekly expected moves. So 68% of the time, it finishes within there. Now, as far as today goes, how do we start? This anchored VWAP, right? That's the week to date. It's the daily, because it's the first day of the trading month, right? And then we also have month-to-date anchored VWAP too. It's all the same level right here as it stands. Where did we finish? Well, we're currently below it. Okay, well, we're currently below it, closing around the low of the day. We've been on a monster run, so all we're really doing is consolidating here. We're above a 5-day moving average. So in the shorter term, I think we're still bullish here. Unless if that obviously quickly changes. But as it stands, the current price action is bullish. Now, would I go long right here? Not necessarily. I may look to see a going long if we get back above the week to date, month to date anchored VWAP. But if you're starting to look for pullbacks, what can we potentially look for? Well, if we go ahead and measure an anchored VWAP to the April low, what happens here is you can see price hasn't actually reconnected with that. And I think it's very likely that at some point we can reconnect with that. So if price comes down there, the anchored VWAP will be roughly around the lower daily expected move tomorrow. So this could be a potential area to watch price action to see how it develops to potentially buy into it for a bounce. Remember, if it comes down here, the 5-day moving average will be coming up too, and that could potentially act as a level of support as well. So even if it comes down here, we'll be above a 5-day moving average. You want to see how price works in that area. Maybe look at a lower time frame to see if price starts to base out, and then potentially look to go long for a bounce. That would be something that I'm looking for. Or to see how price, if it opens up, if it goes down and doesn't reach there, but it starts moving like this, I would start to look at the week to date, right? Anchored VWAP, and see if we can get price to break above that. And then I'd play that up into the daily expected move, potentially further depending on how price action overall is playing. But that's kind of what I'm seeing right now. Still, obviously, a little bit frothy of a move. We're kind of taking a little bit of a a breather as it stands. And the same thing here goes for the Qs. We did finish below that week-to-date, month-to-date, daily anchored VWAP. If I measure actually the anchor VWAP to the April low here, it's below the daily. But if I were to just measure it from this gap up or from this candle before that gap up, that anchor VWAP would come in something like that, okay? Because I measured it already and I looked at it. I just didn't add it. So if the Qs get hit, start to look for that lower daily expected move, right? We're still above the 5-day moving average. Or potentially if it gets hit a little bit harder, potentially watch for the April low to come into play to see how price plays around that area. On the other note, if you want to play long, if we just don't make it all the way down there, we start turning back up, I would still wait to, see how price responds, maybe, first 30 minutes, hour of the day to see how price, what it does, let the volatility, settle down a little bit. And I'd be looking for a move above the week to date, month to date anchored VWAP to see if I can play it into that upper daily expected move. That's what I'm looking for going into tomorrow, everybody. That's all I got for you on today's episode. Have a wonderful night.